Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community.
I'm Nathan Stovall, and thanks for joining us in another installment of Tales from Top Performers, where we talk with executives at high-performing banks about their institution and experience in the sector, their views on current issues facing the industry, and the greatest challenges and opportunities they see ahead. My colleague, Jimmy Pinger, who leads our U.S. Financial Institutions commercial team, is joining me again on the show. Jimmy, thanks for being here.
Absolutely. We're delighted to have C.K. Lee, President and CEO of Oklahoma City-based InterBank, the $4.7 billion banking subsidiary of Olney Bankshares of Texas, join us on the podcast today. InterBank took the first place ranking in our largest community bank rankings in 2024 and finished in the top 20 the year prior. Nathan, you and I have gotten to know CK over the years as he has served on the advisory board for our Community Bankers Conference. We've always valued his input and thought he would be a great addition to the series, especially considering the performance of InterBank the last couple of years. CK, thank you for joining us today.
Thank you, guys, and it's great to be with you.
Let's go ahead and dive right in. CK, you came into banking with a different background, having worked in the regulatory and investment banking community. What prompted you to make the move to InterBank? What do you love about banking compared to past roles? And what lessons from your time in the regulatory advisory community help shape your approach to leading InterBank?
Well, that's an interesting question. I've either been a strategic planner of my career or I've had attention deficit disorder, depending on who you talk to. But to take your questions in order, I came to InterBank because we knew them well. I had worked with them in the investment banking space. They had never been a client, but I had worked across the table from the InterBank team and the InterBank ownership on a couple of transactions and had grown to appreciate and respect not only them as people, but how they were running the institution. And I would say second, it's a great bank. It comes with some inherent strengths that I think we've really been able to rely on in the last few years to put up the performance numbers that you mentioned earlier. First of all, it has an extraordinarily stable and broad-based and diversified deposit franchise, which is, as you guys know, the backbone of any good bank. And it had ownership with a bias towards supporting communities and loaning money, which I feel like is a critical function of the banking space. And so I think there was a mutual sense that both my background could be of use to them as they faced the next opportunities of growth and expansion here in Texas and Oklahoma, but also that it gave me a chance to put into practice a lot of the things that I had learned and come in to contact with in my prior lives as a regulator and as an investment banker. And I really feel like that background has been a help to us in a couple of ways. One, I think particularly on the regulatory side, you really, having sat on that side of the desk during some very difficult times for the industry and having sat in boardrooms in crisis and managed people in crisis, it really gives you an opportunity to understand the mindset on the other side of the table and help you understand what motivates regulators. It gives you a good understanding of the depth of the regulations and what stands behind them, not only from the perspective of the regulators themselves, but even the policy that underpins it from the laws that these regulations are based on. And I'll give you a couple of examples. We spend a lot of time with our regulators, as you can imagine, talking about capital, given our commercial real estate focus and concentration here in the markets that we serve. And I think just understanding the distinction between risk-based capital and tier one capital, the good old leverage calculation, and how we believe that the way we've built our bank really doesn't allow risk-based capital to be true and accurate representation of our ability to absorb risk. That the better metric for us to follow, given how we've built the bank, is the tier one leverage framework. And having sat in the room in international meetings where we've built risk-based capital and we've seen the kind of incentives that were behind the policymakers when they set all that up, it really helps us have a more granular and more sophisticated conversation, I think, and defend our business model in the face of, what can be understandable regulatory pressure to focus on one metric over the other. And so I think those, that kind of background does give you perspective that's helpful when you sit in a chair like the one that I sit in now, and you have to kind of lead those conversations and justify the bank's business plan in the face of pressure, because we are different from a lot of other banks and we manage the business a little differently, and we're not a bank that you can neatly put into a box and categorize. And so that requires some discussion and some explanation when it comes to the regulatory conversations. And I think certainly when I got here 5 years ago, we had a very favorable interest rate environment. As you'll recall, it was in the depths of the pandemic, and we exercised the opportunity then to take on some subordinated debt to get some capital while rates were low. And having contacts in that business and having run those deals from the other side of the desk in the capital markets, it gave us a real opportunity to put a team together in our corner that helped us raise some deep, both defensive and offensive capital, really, and at a very attractive rate in the marketplace. And so I think having that experience informed that process and really helped us succeed in that effort. So the background helps, but I'll tell you, nothing really prepares you for the day-to-day operations of a bank and the types of things that come up here. And, whether it's on the credit front or the growth front or the opportunity to manage people, those are all things that I've had to learn on the job. And I've thankfully been surrounded by ownership and a team here at the bank that is deeply steeped in these things and has a long history in building this bank and its business plan. And they've been very helpful to me in filling in all of the gaps that my background hadn't filled in when I got to my first day on the job. So it's been a wonderful opportunity.
One of the things about InterBank and your time there is that the returns the bank has produced are really superior and driven in no small part by your margin, which I think would be the envy of any bank. And you've talked about this before, but when rates were lower, one of the things you guys did right is you didn't reach out the yield curve. You didn't look for yield, and you were patient. What gave you conviction to do that and really wait for rates to move? I mean, it's still paying off today.
Well, I think it might be Warren Buffett who said there are three types of people in the business world. There are innovators, there are imitators, and then there's incompetence. And we try to avoid incompetence here, so that leaves us to pick from the other two. And really, the innovator in our bank has been our owner. We're owned predominantly by an individual named Ross McKnight. He's a rancher and cattle feeder from West Texas who also has an oil and gas business. And since 1987, he's owned the bank. And I would say the innovation that he's brought to this place has been really to take the bank to first principles and stay there over the 38 years that we've been in business. And it's really interesting to see the discipline that they've had through good times and bad times and through the various interest rate cycles to hold true to the fundamental banking philosophy that sits behind everything that we do here. And it's not complicated. The formula is relatively simple, and you can see it when you look at our call report. We don't purchase investment securities. We take deposits in and we make loans. And that's pretty simple. It's kind of a core banking philosophy, but I think we've allowed modern risk management theory to allow banks to dabble at being bond funds and to speculate on interest rate risk in the bond portfolio, which, as we've seen, when you have rapid shifts, can really be disruptive to the income statement and to the capital accounts. And so we avoided that just because of our ownership's philosophy that we're here to take deposits, serve our communities, and provide a safe place for money, and then also loan it back out and to support our communities through making responsible loans to folks who are doing good work out there and trying to make money themselves. And so it's a really simple philosophy. The other thing that we've done that I think our ownership has held firm on over the years is we've ensured that most of our loan book is adjustable rate versus fixed rate. And so it allows us to ride with the interest rate cycle. And as you know, the interest rate cycle both gives and it takes. And so during the pandemic, when the Fed significantly cut rates, down to 25 basis points, we were living in an era where most of our loan book was sitting at prime rate at a number right around 4% on an all-in yield basis. And so it's tough to make a living in those times. And so you have to, if you're going to run the bank this way, you have to really control both your deposit cost, which we're able to do through the deposit franchise that I mentioned earlier, but you've also got to control your non-interest expense. And I think, that's another great thing that our ownership has done over the years and built into the DNA of this bank is just we don't spend money on things we don't need. And we don't have a lot of middle management in our bank. I sit in the CEO chair, but all of my community bank presidents and all the rooftops work directly for me. And each of them is responsible for everything that happens in that rooftop. So if there's a pothole in the parking lot or an ATM machine that's broken or a teller that needs hiring, our community bank president is responsible for taking care of that. And anything that they need discussion about comes directly to me. And so we don't have a facilities person, we don't have regional leadership, those kind of things that take up a lot of expense and introduce bureaucratic inertia into organizations. We've been able to avoid that. And some of that is just good old-fashioned business philosophy, but a lot of it is really driven by the fact that we have to build this bank to be a top performer, not just when interest rates are high, but we've got to build it to be a top performer when interest rates are low, because we live and die by the rate cycle. And so it's really forced us to have that level of discipline on the expense side that, when interest rates normalize, like we saw over the last 3 or 4 years, and that's what they've done. They haven't gone extraordinarily high. They've just normalized back to where the prime rate has lived for most of my lifetime, which is in that 7 to 9% range. And we built a lot of really good economies, by the way, and with a prime rate in that area, both the Reagan boom of the 80s and the Clinton economy of the 90s. And we've gotten interest rates back to where they've always lived. And because we've been disciplined through the down cycles, it's allowed us to really prosper when the cycle comes back our way. And that's an innovation that I think our ownership has brought to us. And, the imitators in our bank are people like me who try to not only understand that philosophy, but implement it in the granular decisions that we're making every day at the bank, whether it's on spending money or making loans or constructing and structuring credit. We try to push that out into the future so that we can continue to enjoy the kind of performance that we've had here over the years.
CK, a follow-up there. Do you think that philosophy and the ownership that you're giving to your market presidents has really allowed you to attract talent to InterBank versus your peers?
Yeah, I think it has. We're blessed in our bank with folks who have spent most of their careers here. So not only are they from the communities that they're serving, and they know everything that's going on there, but they're deeply immersed in our bank and our philosophy and our culture. And it really helps make my job a lot easier because I don't have to spend all day fending off pie in the sky expense or request or project requests, because people here already know the answer largely to those questions, and they go ahead and implement them in their bank. And a lot of what I'm doing is just confirming their logic, and that makes my job a lot easier. And I do think it contributes to the success of our bank. Another thing that we do very well here, which again I think comes from our ownership and the way they run the bank, is we stay in touch on a personal basis with each of our bank presidents. And we've got 40, 45 banking rooftops, around around the empire, from Western Oklahoma, West Texas, the Dallas-Fort Worth Metroplex, and Oklahoma City. That's kind of our footprint. And every month, our owner and I make a trip to each of those regions, and we meet in person through advisory board committee meetings with each of those bank presidents and hear them talk personally about their new and renewed loans, their overdraft lists, past dues, problems, watch credits, criticized loans, workouts, progress on dispensing with real estate that we own. And all of that gives us a very granular and regular touch on what's happening out there in the banks. And it's a two-way street. They educate us on what's happening in their community, the challenges and opportunities that they face, and then we can reinforce for them the culture that we've built over the decades in this bank and that we expect them to continue to enforce going into the future. And so we don't just delegate and forget. We spend a lot of time with the individuals going over the reports and really understanding what's happening in those banks and trying to deal with problems when they're small problems and not waiting for them to become big enough to bubble up to the C-suite, and then suddenly it becomes a crisis that everybody has to drop everything and deal with. So it's a philosophy that's worked well for this bank over the decades, and I think I benefited greatly because when I came here, I didn't carry with me a lot of baggage of how we've done it at other banks, and so I was able to come in and sort of witness the underpinnings and the foundations of this bank's prosperity and really have that be my first imprint about operating a bank. And I think that's the sort of succession planning that ownership had in mind when they decided to go outside the normal banking industry and pick a non-traditional candidate like myself to come in and sort of be the next generation of leadership. And it's something that, I have no intention of really altering the model because the performance speaks for itself.
You talked about preparing for higher rates and the positioning you had then, and that really benefited with loan yields that are quite envious as well and helping drive that margin. How are you thinking about positioning your balance sheet now with the bias being down rates? I mean, I've been in the camp that maybe we don't see much movement this year, but just generally, how are you thinking about the rate environment and positioning the balance sheet?
Yeah, we laugh a lot around here that our ownership built the bank for 35 years for this rate environment. And there's no question the last 3 or 4 years have been extraordinary performance years for us. But I will tell you that when it comes to positioning for the future, we're not going to do anything different than we've historically done. And we accept that our model is going to lead to a diminishing revenue stream when interest rates decline, and will benefit obviously when they go up. And we understand that, and we don't spend a lot of time thinking about budgeting around here because we really do what we do, and if we do that correctly, then we'll prosper whether rates are down or whether rates are up. I will say this, that we are extraordinarily fortunate in where we are located in the world because we're in a region of the country that is attracting a tremendous demographic inflow. And that demographic inflow is leading to a real need in our region for things that are right down the fairway of what community banks were built to do. We bank a lot of sponsorship entities that build multifamily housing, 1 to 4 housing, self-storage units, industrial warehouse. All of those things are products that are needed and consumed by people who are moving to the region for the first time. They need a place to live. They need a place to store their goods. There's a need to have forward industrial operating facilities to get goods and services out to them. And so all of those things are in the fairway of what we loan money on. And so that's allowed us to really grow the bank. And we just completed our board cycle for this month. And one of the messages we communicated both to our employees and our outside directors is the fact that over the last 8 to 12 months, we've been able to grow our bank significantly due to really good quality loan demand. And that's allowed us to effectively repair the revenue stream that we lost last fall when the Fed backed up 100 basis points on us. And so we took that we took that revenue diminishment, understanding that that's part of how we built the bank. It's part of our philosophy. But we've been able to repair that due to great loan demand, and we've grown the loan book. And if you look at our net interest income per day and our net income per day in June, we are back to where we were in the heydays of 2023 and 2024 when the rate environment was 100 basis points higher. And we did that by growing the balance sheet by about $500 million. And we've been able to capitalize that growth through retained earnings. And we haven't had to go and do anything extraordinary to provide the capital underpinnings for that growth. And we've been able to do it by driving our deals on credit and not accepting what we would view as undue credit risk. And so I think once you go through a cycle or two like that, particularly me as a relatively new guy here and understanding the philosophy, you develop confidence in the bank to withstand those cycles where the interest rates back up on you a little bit. And yeah, you may suffer a quarter or two of revenue diminishment, but if you're doing all the right things and you're managing your pipeline correctly, you're able to really make that up through loan growth and through responsible balance sheet growth.
How are you feeling about credit? And, have you seen any, you're in a great market, as you mentioned, but, have you seen any impact from tariffs? Are you seeing any cracks in the armor, so to speak, in your borrower base, or seeing things from competitors that makes you nervous?
Well, most of our loans, because we're an adjustable rate bank, it really biases us toward the construction finance business. And there's some benefits to that because these loans fund up and then they stay on our balance sheet for 6-8 months and stabilize, and then they move off either because our sponsor sold the project or it gets turned out in a long-term financing facility that we're not a part of. And so that balance sheet velocity allows us to really re-examine and re-underwrite a tremendous amount of our loan portfolio every 18 to 24 months. And so that money comes back to us, and then we're able to loan it back out and re-underwrite to the environment that we're in. And again, I think that's a testament to the operating philosophy of our ownership is we haven't got ourselves locked into a bunch of 10 and 15-year fixed rate loans where we're underwriting a commercial real estate project in 2010, and you're still sitting on that same project and the same leverage and the same interest rate that you set 10 years ago, and you really haven't moved around much. And yet the underlying fundamentals, both on the property itself and the operating environment, may have changed significantly. And so we just try to avoid those kind of long-term commitments when it comes to balance sheet management, because we want the ability to get the money back in the bank from a liquidity perspective and then re-underwrite a new credit, which allows us to take into account some of the things you talked about. And I think there's no question that if you loan money on construction projects, you've seen significant price increases on building materials, labor, all of the things that go into that. And we try to obviously build contingencies into the budget to make sure we understand our sponsors' ability to withstand. And most of what we're underwriting are very large, sophisticated developers who have been through the cycles and are dealing with extraordinarily competent general contractors who have the ability to lock in prices, 6 to 8 to 12 months into the future. And so we haven't seen a tremendous amount of volatility like what you would think if you were watching CNBC every morning. You would think that everything's gone up 50% because of uncertainty in the tariff world. There hasn't been anything that disruptive that showed up on our radar screen yet, but I think there's no question that over time, this rebalancing of the terms of trade, however necessary that may be in the global economic environment, will have an impact ultimately on a lot of the things that our borrowers use to construct and build their projects. And so we're keeping an eye out on that. And obviously any new projects that we're underwriting get tested pretty significantly to make sure that both our sponsors and the project itself has the contingency funding available to withstand those kind of things if they occur. But you're asking about credit. I mean, we haven't really seen a significant deterioration in the credit environment here. And I think that has everything to do with the demographic inflow that continues to feed our region and the place where we lend money.
CK, speaking of that region, we came into this cycle expecting a significant rebound in M&A activity. With the tariff tantrum, the market seemed to have put a lot of those deals on hold, but we're really starting to see evidence of that pickup, especially over the last month. Just this week, we saw some activity in your market with the acquisition of Veritex by Huntington Bank announcement. What do you think we're going to see in the second half of 2025?
Well, I think we'll see more of it. And again, I'm talking here as a reformed investment banker. And I've always felt like M&A is just really a function of stock prices in the banking sector. And so as they've gotten their currency back, our serial acquirers are coming back off the sidelines and they're jumping in. And you saw Cadence Bank make a deal here in Texas. We've seen a number of small banks merging just for scale. I think that kind of confidence is manifesting itself in the M&A markets. And then obviously the Veritex trade was a big one that, will have, continue to ripple through our regional banking sector here for a while as that deal gets closed and integrated. Plus, I think the regulatory environment has loosened up a little bit. The regulators have said, and I think they've actually done this in practice. They don't sit on these deals for 2 years like they used to, and the thought is you file an application and push it through and get it approved in a reasonable amount of time. And I think that's the normal course, and we're going to get back to that, and that's going to feed the M&A markets a little bit. But it's really hard for us to participate in that game because, and we've looked at 15, 20 deals since I've been here, and it seems like everything we look at would dilute us. It would dilute us from a return on assets. It would dilute us from return on equity. It would dilute us from an efficiency basis. It would dilute us in terms of management time and attention. All of those things are real barriers to a bank that's performing like we are, to thinking about what the benefit of M&A would be for us. And so we spend a lot of our time thinking about organic growth here. And I think we've built a team that has the capacity to grow this bank. I mean, just to give you an example, in the last 6 months, we put on just under $500 million in deposits, and we put on just over $500 million in loans and about $450-60 million in assets. And so, as we were talking about in our board meeting yesterday, we've built a decent sized community bank in one of the best regions in the country just in the last 6 or 8 months here, purely on an organic basis. We haven't taken on any additional non-interest expense to do that. We've taken on interest expense, but we've been able to maintain that 5-point margin that Nathan talked about earlier. We have that kind of customer base. We have that kind of operating environment. And we have the economies of scale that have already been built in by our ownership through decades of acquisitions. So all of the acquisition work to get us to scale was done before I got here. And the great blessing of my life every day is that I don't have to sit around and worry about scale. I have to worry about making sure we're able to drive our deal in the marketplace and to make sure that we have a shovel that's big enough to get to the gold mine that we sit on here. And those are the kind of first world problems that you have when you don't need to do M&A and you don't need to take on that management distraction. And so we talk a lot about that here, and it's rare that we see anything that we feel like would bring value that we don't already have under the rooftop here.
All right, we end every one of these podcasts with this question. Over the next 12 months, what is the largest concern and largest opportunity for your institution?
Well, I think certainly the largest opportunity is to continue to lean into the growth that we're seeing in our region and be able to not only continue to find the good loans with the good sponsors that we bank, but also to fund them. And I think, most banks in this region will tell you that funding is always a challenge, and the incremental dollar of wholesale funding that it takes to grow the balance sheet to accommodate loan growth is very expensive. We've worked really hard to balance the adjustable rate asset side of our balance sheet with an adjustable rate liability side, but it's not a perfect one for one. And so certainly the interest rate environment would be a challenge if we do see rate reductions. And I think most of us are in the camp of we'll see some of that over the next year. There will be some additional reductions in the interest rate environment. So we'll watch that closely because it impacts us perhaps more than other institutions. But I think also just the broader economic environment is one that we spend a lot of time on. And we think a lot about, the impact of this, as I mentioned earlier, the rebalancing of the terms of trade and the geopolitical tensions that we're seeing. They don't affect us directly, but they affect the operating environment. They affect the decisions that our customers make and their customers make. And so some of that will filter back up onto us. And we just want to make sure we see it a long way off and that we understand what's driving our growth. And if there's any slowdown in any of the factors that drive our growth, that we're catching that early and not getting in a situation where, we keep loaning money into a situation that may be deteriorating. So, like everything else in this business, you've just got to be vigilant and you've got to stick to your knitting on credit and make sure that you've got the right people in the right seats. And we feel like if we do that we'll continue to prosper.
Well, you've certainly performed over the last couple of years. So thank you for joining us. This has been very informative and we really appreciate your time.
Hey, it's great being with you guys and thanks for the opportunity.
Absolutely. Look forward to talking soon. Thanks.